Welcome to the 301 Club,
Welcome, welcome.
where we teach you how to build real estate in your 20s. Like
Yep.
and subscribe. And on today's episode, we're going to talk about negotiating.
Yep, we're leveraging pre-approvals. So last episode, I know we talked about different loan officers and talking to them, talking to banks in order to get those loan officers because they're not going to be there the day of. So, just once you get in contact with them, you go through that process, you get the pre-approval done, which is essentially just a letter that approves you. They run your credit and whatnot, and then all that entails that, your work history, all that, your the amount of money that you have in your bank account. Sometimes they'll check that, especially if the bank is working directly with the loan officer.
Right. So at this point, you know your worth.
Once you find your loan officers and you have several approvals, leveraging those pre-approvals so that you can essentially not pay or get a better rate for sticking to a different loan officer. So that's kind of what I guess you can get into is doing that and like talking to different loan officers, because I know you took care of that on your end because you took those steps to take the loan under your name.
Yeah. So at this point, it's going to be, you know your worth, and everything is going to be just straight emails at this point or phone calls, because as you've already collected all of your lenders and you've proven your worth and you've shown them your credit score and your capital and you've sourced your capital, this is the point where you need to start negotiating. And what that entails is to make sure you have everything on paper. So, and what this means is you're going to be emailing your lender a lot. And a specific experience that happened with us is, and just so you all know, there's an application fee that each bank is going to charge you, and it's going to range from about $500 to $1,700 depending on where you're going. And specifically in our instance, it was supposed to be a commitment fee, is also another term for it, of $1,458. And we got an email from our loan officer who recommended that, oh, if you choose us as your bank that will give the loan, that we're going to give you a credit of $575. But at the end of the day, he never ended up giving us that loan. And the reason for that is because once you have already put an offer on a house, or you've chosen and you want to put an offer on a house, you really do need to make sure that the contract is ratified before you choose a lender, because you have up until the point of ratifying the contract with the seller to choose a lender.
Right. So I think to get into the PNC first, that's like the first bank that we went to, and then we were able to figure out that they were giving out grants, and there's different pluses and negatives to working with certain banks. And I think it's your job to, like, your responsibility actually, to make sure that you leverage everything and you do your due diligence. If you've already set and you've picked the top three choices, working with those loan officers, getting a pre-approval, comparing the rates, doing all your due diligence. If you have another person involved, running joint pre-approvals, see which one is like the best option and going with that. And so I think that's what ended up happening. I think that's how we figured, like, to move a certain way and move a certain bank and whatnot. And I think you can get into, like, when you talk to the loan officers, there's like different sort of loans. There's different sort of ways to do it.
Yeah, so there's one super huge story about what you're talking about related to negotiating and understanding what loan your officer is even giving you, because there's different types of first-time homebuyer loans: FHA, Home Possible, Home Ready, backed by Fannie Mae, Freddie Mac. These are quasi-government entities that just make sure that loans are getting paid so that the market doesn't bubble up and crash. But there's another piece of this, which is when you first talk to a loan officer, they're going to recommend as a first-time home buyer. But the misconception is that you can still get a conventional loan, which doesn't mean you have to be her first-time home buyer. But on top of that, you can get grants, like John mentioned. And what that entails is also you only need to really put 3% down, and this is depending on your credit score. So that's the advantage of the Home Possible and the Home Ready loan, which is a new loan since about 2015. Backed by Freddie Mae, Fannie Mac, Fannie Mae, and they're going to give you more flexibility on where you can source your income. Because, for example, an FHA loan, you're not allowed to source from other individuals, but the Home Possible and the Home Ready, you can use different people besides your own capital.
Yeah, and I think that means, like we spoke on the last episode, inheritance, savings, or I'm sorry, gifts, and also of course your savings, but that's not really from other sources. But you can source from other people, and if you have family members that are willing to help you with that, you can receive gifts. Like I said, all those things, and yeah, that's very important to keep in mind because if you have family, it's better to try to use that as a as an opportunity to like help you with your future. So if you have parents willing to help you out with that, that's a good idea to keep that in mind.
Yeah, you really want your negotiation powers to be at a high level at this point, and you can do that with excess capital because there's one story specifically with our lender Juan Carlos where we went in and we requested a conventional 3% loan because that's all that we needed based off of our credit score. And what it was backed by was that it was going to be a home ready loan. However, Juan Carlos decides that he wants us to add more down payment, so he wants us to do 5%. So he texts me, I'm at work, and I decide that this is not acceptable, and I need to talk with someone like a mentor or a business partner.
Well, it was more just like getting like my like sort of like opinion on it, and I just I checked the facts. He requested it, he wanted it. There's a difference between need and want. And I think it's important to understand that if it's not in writing, he's just asking and inquiring about it. I told you, and I think it's good to keep in mind is like if they're not necessarily putting it in paper, it's not a requirement to continue working with them. Then it's something that's negotiable. So if it's negotiable, then you say, listen, I know you're requesting 5%, but I can't pull it together. Maybe I can only do 3. So let's work on it. And so I think you ended up taking care of that, and you took that information. I think you like also were able to work with him and.
It comes down once again, the negotiation, main theme is knowing your worth. And when someone tries to strong arm you, then you just have to come back with them with the same amount of force and say, in my case,
let's just stand your ground.
My credit score is good enough for this home ready loan.
Yeah.
Which we looked into Google and we realized that you only needed up to a 50% DTI and credit score over 640, which we had. Which we recommend everyone should have at least those standards before going for any type of loan, because these are going to be the easiest and most attainable loans for first-time home buyers. But basically going into it,
I think it's more just standing your ground and knowing, like you said, knowing your worth, standing your ground. So it's like if it's not a requirement, try to work with your loan officer. They are they want to work for you. They want to get your business. So they are going to be they're more than likely they're going to work with you. So if you try to negotiate, they'll probably more than likely appease you and work with you and give you what you want. But you have to be able to stand your ground, and if they're requiring you or they're asking for you, if you're able to get more money, just stand your ground and say you can't. What I mean? Even if you don't have the best of credit scores, or if you do, you can work with them and come to a middle ground, or you know what, that's the line, I can't cross that, I can't do any more than that. So just, knowing that and, standing your ground, I think that's important.
Right. And then just be prepared. So to sum it up, basically, your loan officer is paid on a commission. In general, they're going to be paid on a commission based off of, if they sell you the loan at the end of the day. And again, you can choose until the ratification of the contract, which is when the seller agrees to sell the house to you. So at this point, we haven't ratified yet with the seller. And Juan comes back to me in negotiation with you're not being approved by the computer by a pre-approval process
because your DTI,
right? Because my DTI, but I responded back that it's under the federal limit that the Freddie Mac backing is requiring, and he says, but no, we can't continue with you. And so my response is, okay, I'm going to talk to Northwest Financial. Thank you so much. Hung up on the phone. 5 minutes later, he calls me back and says, "Hey, you can do the 3%." So
yeah, knowing your facts,
from standing your ground and knowing your worth
and facts, knowing that the federal limit was, or the federal suggested rate was that amount. So just knowing that and understanding that you can leverage that information, and don't be afraid to walk away. Exactly, just that's important, because if you have other options, go with the other options. You don't have to, risk or go back on what you already set out as like the bottom line for you. And if that's the bottom line for you, don't budge from that. If you have always like keep the original goal you had in mind from the beginning, and and keep that going. So don't like fold for for someone trying to get more money out of you or whatever it may be, unless it's absolutely necessary and it's worth it. Maybe they're offering incentives, but yeah. I guess I just wanted to throw that in there for people.
Yeah, and then I think once you've finally negotiated the terms of the down payment, then you got to the interest rate, and the experience that we had with that was it went pretty smooth. When it's pretty simple to email your loan officer an estimate from another bank. They'll look at it and already be able to tell you what's going on. And the fact with our case with Juan Carlos, this is a great thing that he did for us, is that he told me that two incomes together were over the threshold of the home ready loan that this other Northwest bank gave me an estimate for, but they still gave me the interest rate for that loan. And so I was able to show him that interest rate, and he knew that I wasn't going to qualify with two incomes, so we decided to just do it with one borrower, and that still qualified me, and I even got a lower interest rate because of this.
Right. So using all your options, and we talked about it before, which is like if you have two people involved, there's like if making sure you see which one's the better option, if it's better to do a joint or a singular and whatnot. And that goes into the next topic of like once you do the singular, how you're going to source funds, because
Right.
funds have to be sourced in a
From the
particular
borrower.
way, from the
From the
borrower.
borrower in most cases, but
In most
there's-
cases, that's what usually happens. And,
Yeah.
and luckily enough, I think you can get into it. But I know you mentioned that you got a little bit of some sourced for money from family, and so I think that's important. I think that's something that a lot of people don't kind of like lean into that. So
Yeah, you can lean in multiple ways, because first you're going to have your money sourced, which means proven to the bank that you have this capital. So it's not going to be a good idea to have cash laying around, but your family can gift you the loan and
yeah,
in
because I
cash.
think because if you have cash laying around, like the bank needs to verify that you have that money in your account. So a lot of loan officers are going to check that when they run your credit. They're also going to check your bank account. I think it depends on which. I think they ask for your
Yeah,
last two statements or something like that.
So every loan will require you to show two bank statements from the past 60 days. So you don't want to have any large transactions of cash, definitely within the 60 days of you ratifying your contract and thus getting a loan. But proving your sources can come from different avenues as well, and that can be your retirement account. Like we said, if there's cash on hands, it'll be gift funds, or if and take advantage of an inheritance, because that is actually going to be the best securement for you to show to your loan officer, because when he's going to decide if he wants to give you this loan or not, or give you a lower interest rate, he's going to be able to look at your bank history, and specifically if you're applying at a bank that you already have an account with, they're going to know your income. Just a heads up, and that's the truth.
And I was gonna say this to touch base back on what you said earlier about if you have large transactions. So if you pull up your last two bank statements and you're trying to put a down payment, but you got a gift from a family member and you put that in within those last two bank statements, they're gonna want to know. So like, where did that money come from? Okay, it came from your family member. They're gonna get a letter from your family member. They gotta verify everything. So they're gonna do their due diligence, and it's your job to make sure that you provide all the information and that you do source everything that you like. You do source or you do provide the sources for all the money that is there in those last two bank statements. If if there's anything irregular, if they see that, because they want to verify that income is either coming from directly from you and your job, or it's coming from a gift or whatever it may be. And so your job is to provide those sources and to provide any information that they request. And if you don't, then obviously you're not going to have a good chance of getting that pre-approval or that loan that you would like.
Yeah, and so let's go into kind of how we sourced our purchase of the house that we're in right now.
Well,
you
I
could
guess
use the 401k.
Yeah, an inheritance or anything like that.
Yeah, so
I know you did-
specifically-
I know that's what you did, so you can get into that.
Yeah,
My
this
bad.
is like maybe something that it would be interesting to know, is that if you have a retirement account with your employer, you're actually allowed to take out about half of that. With me, it was Fidelity, so they allowed me up to 50% of my total amount in the 401k for a first-time home buyer, right? So this goes back into advantage of being a first-time home buyer, having one borrower. The only thing is that you're going to need to prove the source of this funds, and you can do that through bank history. But another way is through wiring money. And this is the way that the banks are going to prefer, and this is what's going to come through gifts or, primarily it was us just through gifts in our experience.
Yeah, because I
that
know you
you
had
can-
that's what you did, and I think that wiring money, just to like jump in here, because I think what all the bank wants to do is they want to verify where their money's coming from. They want to verify that the money is actually there. So like if you're doing a check, it's gonna take more. So like if you're running on a time crunch, and if you have a month to close, you want to make sure that you're running things smoothly. So sometimes it's better to do a wire versus a check, because if you do a wire, they know that the difference between a wire and a check, from what I know right now, is a wire is it'll let the person that's receiving the wire know that the money is there. For a check, it takes a day or two to make sure that the money that is on paper is actually there. So a wire is more direct, it's quicker. So the banks will trust the fact that if there's a wire that goes through, that money is there. They don't have to source where the money's coming from, make sure the money's actually there, that the check doesn't bounce, etc. But that's kind of how.
Yeah, and on top of this, another sheet to hide under is the fact that you're sending this money to your title company, the third party in the state of Maryland, in our experience. So, and you can always choose to do this, is send your money to a third party, and that way
you mean the title company?
that way they
I mean that I think
receipts are
it's
there.
not
And
necessarily a
then,
sheet to cover hide under. It's more like a title company is that's kind of like how it would it's a title company is how the buying a house in most states works. So you always have to go through a third party, but the job of the third party is to verify the funds, hold the funds. That's what a title company does. It holds things in escrow, so it makes sure that the money that's being the transaction that's happening between the person selling the house versus the person buying the house. What the title company does is, which we're gonna have to look into, and we've spoke about it before, is they'll make sure the money's there, they'll hold the money there, and they'll release the money once everything is signed in paper, everything's set in stone. So they facilitate the process of buying a house or selling a house, essentially. So and they are the ones that receive the wire. They're the ones that take care of all of that, And so it's important to understand, if you're running under a certain amount of like restriction when it comes to time, is to make sure that you do your due diligence, and if you can't send a check, or if that doesn't work in the time frame, do the wire. Because sometimes if you're working with a family member, you have to get their bank statements, their checks. So like I know that's something that happens, and I know we've talked about in your experience.
Checks, bank statements.
So sometimes a family member may be like, I know you told me about this, and I don't want to speak for you, but like it just seems like sometimes that it's gonna take some time to gather all this information, especially if you're working with a different person, or rather a family member. So it's just important to understand that. So when it comes to sending a wire to your title company, it's quicker, it's faster. They verify the money's there, and then obviously I know some loan offers, they require a gift letter. So that's also something important to keep in mind. And you talk to your loan, we did the due diligence for people out there. Just make sure you talk to your loan officer and see what the stipulations are, the requirements. But across the board, it's usually that they need a gift notice or letter from the person giving you the money, saying that they gave you the money. And then the wire just makes it quicker, so you don't have to get the bank statements and whatnot.
Yeah, exactly. And I think this is a smooth transition into our mistake, which is exactly with maybe choosing the title company when it comes to sourcing your funds. They're going to be the people who track this, right? And the loan officer is going to be involved as well, because they're all different players on your team, So one thing we decided to do is that, again, if you have an employer, I would double check with them that you can get a discount, or maybe even for free, which is what happened to me with your title company. However, you would want to check the reviews on this title company, because they might not always be the best, considering that they're under a program such as, I use ARAG, ARAG.com. Shout out to that website, because talk to your employer, talk to that website, and then you may get a title company for free. What I mean by for free is you're saving about $500 to $750 in your closing costs because of this. And
just sourcing,
what can actually happen is that you should also ask your realtor if there's maybe like a title company that they know or they recommend, because in our case the title company was in the same building as the realtor, and it would have helped a lot with logistics when it comes to closing,
communication. It just would have helped things, facilitate things, make some things more smoother. We don't really have to do a lot of the talking, and I think in that situation, I'm sure the realtor would have done their due diligence and worked with the loan officer directly, and so there would have been, the communication would have probably gone a lot quicker. They probably could have got a lot of it done, but it comes at a cost. So if you're willing to put that money up, I think it's better to do that. And we learned maybe it would be because we just didn't have the greatest experience with the title company. It wasn't like the worst. It's just, it was more like, you know what I mean? Towards the end,
like the logistics, they didn't
it's
come
just
through with great
communication. I think
logistics
it's
and
just
the
I think it's
communication
just
of the
communicate.
closing.
Yeah, that's what it
Yeah.
comes down to. It's just a communication. You have to like wait. It's just adds another step. So like you have to wait till you hear from this person, then you have to communicate with the realtor. So it's like that kind of slows things up. So I think that's something to keep in mind. And like to touch base on like sourcing information, I know in my experience, I had a loan officer. It was a friend that was a loan officer, so I did ask him some questions. So, and he actually tried to get me a loan, or he tried to like make it work and give me an estimate, but it seemed like his rate was too high and he couldn't compare or couldn't compete with, the offers that you were getting, when I tried. So essentially, like that's kind of like just a good thing to keep in mind, but also understand that sometimes that happens where it's like you have your source when it doesn't really come out the way you want it to. It's like you at least a good thing is trying, and then if it doesn't work out, you move on to the next thing. But the important thing is, I feel like for the most part, if you do get lucky, they might be able to offer you a better option than what you were to get if you were to go to a bank per se. So it's just like do your due diligence. Try to increase the amount of like, what is the word for it, when you're scouting for pre-approvals.
Your leverage.
Yeah, you're just leveraging the people that and also like leveraging the amount of banks that there are.
Yeah, rule of three, man.
Yeah,
Always.
rule of three. Yeah, so do all that, but
3 realtors, 3 banks at this point.
Yeah, and I think they've already kind of picked their. Oh, I guess in the next episode
now you will pick your realtor and lender. So at this point, you can start touring houses.
Yeah.
But again, the lender, this is the negotiating skill, is that you don't need to officially end with a lender until the contract is ratified. And that is the end of today's episode.
Yep, that's what we'll see in the next episode. We'll go over, picking a house and what that entails. But, I feel like from what we've talked about today, you should already have a loan officer and a realtor, and you should be ready with a pre-approval, at least one. What'll get you, like, that'll help the process of, picking a house and talking to the seller's agent, so hopefully, you've done your due diligence by now. And so the next episode that comes out, you already have, that preparedness to go into looking at houses, picking one, and then moving on from there.
Definitely. Remember to like and subscribe and
Yes,
do your due diligence. If you have any comments about our stories or our experiences,
or any questions,
comment below.
yes,
Thanks,
sir.
all.
Thanks for watching. See you guys next time.